Are you sick of worrying about your stock or cryptocurrency portfolio? One day you're up 50% popping champagne, the next you're down 100%, sad in bed with a tub of ice cream? Well, today I'm going to help you solve those issues with a dollar cost averaging strategy. Unless you can predict the future, then dollar cost averaging is a great strategy of making smart investment decisions. Fortunately for you, I can actually tell the future. And yours is becoming filthy rich from liking and subscribing to this channel, and comment down below if you do. So what is dollar cost averaging? Well, today I'm going to explain the concept, the pros and cons, when it can make you money and when sometimes it can maybe lose you some money, and then showing you how you can finally get into it. So without further ado, let's get into the video. So if you've been saving up a lot of money and you've got a sizable lump sum ready to invest in something like shares or cryptocurrencies, it can be pretty daunting to think that you might put that money, that hard-earned money, into an investment and it might go down in value. Well, dollar cost averaging is a way to help both experienced and inexperienced investors reduce that risk. So I think there are three main reasons why you should do dollar cost averaging. So rule number one, dollar cost averaging helps you invest like a robot. It takes all the emotions out of the investing cycle. Answer me this, who would you rather have investing for you? Spock or your crazy uncle? Reason number two, dollar cost averaging means your money is invested and so it's working for you every single day. Rather than trying to time when to put your money into the market, you're just putting it in every single interval and it's working for you. The third reason is that it's really simple and a safe way to invest. If you want more information on microinvesting, which is essentially the dollar cost averaging approach, click through to the link that should pop up around here. Okay, so what is dollar cost averaging? It's also known as DCA, and essentially it is making regular small payments over the course of a certain period of time. For example, instead of investing $6,000 in January, you invest $1,000 every month, so January, February, March, April, May, June. The price of the asset might go up and down over time, so either a stock or cryptocurrency, but you invest the same amount each period. So what happens is that you buy more of the stock or cryptocurrency when the price falls and less when it goes high. You might have heard people say that time in the market is more important than time in the market. And I've definitely said this in a property video, the link up top. And so this is where DCA strategy comes in. It's taking the guesswork out of timing the market and making sure that your money is in the market. I'm gonna make some videos about how I invest when I try to find the true value of a stock, which is normally trying to find the bottom. But finding the actual bottom is kind of like whether or not Elizabeth Olsen will give me a shout out. Near impossible. And trying to find that bottom is difficult for even the most experienced investors. And that's what makes the stock market equally exciting and punishing. Have you ever tried to save up your money to buy a stock or a cryptocurrency? And then once you've got it all saved up and you're excited and ready to go, you find that the stock or the cryptocurrency value has skyrocketed and now you're like, well, now it's too expensive. Well, dollar cost averaging is a great approach to making sure that you don't miss out on those opportunities. Okay, so now that you know that dollar cost averaging is putting regular deposits over a certain time period, how does it actually work? Let's use that hypothetical example that I said before, with the $6,000. Okay, let's say that you want to purchase a stock, but that stock price has been going up and down more than Santa Claus on a trampoline. So instead, you make the really smart investment decision of investing $1,000 per month over a 6-month period, instead of $6,000 into the first month. And so this is what it would look like. Rather than investing the entire $6,000 in the first month and ending up with 750 units, you've used dollar cost averaging over a 6-month period. Because the share price moved up and down over the period, you end up buying 1,525 units. And while the price of the share dropped as low as $2 at one point, at the end of the 6-month period, the share was worth $6.66. This means the portfolio of 1,525 units is worth $10,156.50 at this time. If you had instead invested that $6,000 in the beginning, you have around 750 units for about $5,000. So by sticking to the dollar cost averaging approach, you've actually made a profit of $5,000 in this period. This is why some investors choose this strategy, because it means that you're, over time, reducing your risk, but increasing your profit. Keep in mind though, of course, this is a hypothetical example. And in some other hypothetical examples, you can actually lose money. And this is when the stock price is constantly going up. So let's take a look at how that works. Buying low and selling high is one of the golden principles of investing, either in cryptocurrencies or stocks. And that's what happens when the dollar cost averaging with a market that's fluctuating. But When we do dollar cost averaging, when the profit is just going up, we're not buying low and selling high. You're instead buying low and buying high, which is not optimal. So let's take a quick look at how this would work. If the investor had put the full $6,000 to begin with, by the end of the 6-month period, they would own 750 units worth $11,715 in the current market. But by dollar cost averaging over that same period, the investor has ended up with 476 units worth a total of $7,435. This means while they've still made a profit of around $1,400, they haven't made the profit they would have otherwise, which would have been about $4,000 extra. And so I guess that's how you can kind of lose money with the dollar cost averaging approach. But as you can see, you're still making a profit. You just haven't made the most amount of profit that you could have. Personally, I like to reduce my risk and increase my profit. So I still think it's a great approach. All right, so that's a lot of maths and a lot of numbers. So what are some actual real world examples of dollar cost averaging? And in reality, you're actually probably already doing it. For all the Americans out there, g'day. And you would already know about dollar cost averaging from your 401k plans. And in Australia, this is through superannuation. And both are the same. The employer, instead of paying you the full amount of your paycheck, they use some of that money and invest it into the stock market. So those are some real life examples with your employer. That doesn't mean you can't still do it for yourself through investing through cryptocurrencies or stocks. As I said before, there's a video that should link up above here where I've gone in depth on microinvesting apps in Australia and how you can easily get into this strategy. The general idea behind dollar cost averaging is that prices will eventually rise, which isn't that ridiculous when you consider the historical price of the S&P 500 or even the price of Bitcoin. However, when you start using this strategy for individual stocks, it can get a little bit dangerous, especially when you don't know much about the company or their financial reports. That's because dollar cost averaging encourages the investor to continue investing, even when there's a few red flags. For index funds or ETFs, it's a much safer and a great approach because they will eventually go up over time. The key advantage of dollar cost averaging is that it takes away the emotion and the psychology out of the stock market, which I've read a few books on this, and it's one of the biggest downfalls of investors. We can't help it, we're emotional beings. Although it's one of the more basic techniques, I still think it's one of the best, especially when you partner it with ETF purchases. But at the end of the day, your investment decisions are yours and yours alone. Trying to time the market and buying stocks at a discount can pay off really, really well. I do this with a certain percentage of my stock portfolio because I consider it a little bit risky, and I will make videos on how I do that. But if you're looking for that long-term wealth creation, dollar cost averaging is a really good way to reduce your risk and still increase your profit. And while historical averages don't predict the future, you can generally get a sense that markets will eventually rise. And so dollar cost averaging works really well. And I always have more videos, so don't forget to click one here or maybe here for more content. And I'll see you soon. Okay, let's say that you want to buy a stock, but that stock price has been going up. And in Australia, I've actually done a video on